What if I told you that one of the most famous pieces of financial advice in America might actually be costing you hundreds of thousands of dollars over your lifetime? Yeah, I know. That sounds crazy. Because if you have spent any time in the personal finance world, you have probably heard the name Dave Ramsey. Millions of people swear by his advice. His books sell like crazy. His radio show reaches millions every week. And his followers defend his system like it is the financial 10 commandments. And look, to be fair, a lot of people have gotten out of debt using his method. No question about it. But here is the uncomfortable truth. Getting out of debt and building wealth are two very different games. And the math behind Ramsey's system does not always work in your favor. In fact, if you follow his advice exactly as he teaches it, there is a good chance you are leaving tens or even hundreds of thousands of dollars on the table over your lifetime. Not because you are lazy, not because you are bad with money, but because the strategy itself ignores one of the most powerful forces in finance: compound growth. And once you see the numbers, it is really hard to unsee them. But here is what nobody tells you. Let us start with something important. Dave Ramsey's advice works really well for one specific type of person: someone who is overwhelmed by debt, someone drowning in credit cards, someone who needs behavior change, not advanced financial math. And for that person, his system can be life-changing. But here is the issue. Most people watching this video are not just trying to survive financially. You're trying to build wealth. You want to invest, grow your net worth, maybe retire early. And that is where things get complicated. Because Ramsey's system was designed around psychology, not optimization. Imagine you are 28 years old, making $55,000 a year. You have $8,000 in credit card debt at 19% interest. You have $12,000 in student loans at about 5% interest. And you have $3,000 in savings. You want to get out of debt and start investing. Ramsey's advice is simple. Stop investing completely. Throw every extra dollar at debt. Follow the debt snowball. Now, emotionally, that feels great. You start knocking out small debts. Momentum builds. Motivation goes up. But financially, it might not be the smartest move. According to historical market data, the United States stock market has averaged about 10% annual returns over the last 90 years. Meanwhile, many student loans today sit around 4 to 6% interest. So the question becomes this: should you pause investing entirely just to eliminate low-interest debt faster? Or are you accidentally sacrificing future wealth? If this sounds confusing, you are not alone. Millions of people wrestle with this exact dilemma. So let's break this down. First, let us talk about Ramsey's most famous idea: the debt snowball. Here's how it works. You list all your debts from smallest to largest, ignoring interest rates. Then you attack the smallest balance first while making minimum payments on everything else. Once that debt disappears, you roll that payment into the next debt, like a snowball rolling downhill. Emotionally, it is brilliant. You get quick wins. Motivation stays high, but mathematically it is not optimal because interest rates do not care about your motivation. Imagine you have two debts: a $2,000 credit card balance at 12% interest and a $10,000 student loan at 6% interest. Ramsey says attack the 2000 first. And sure, you will knock it out quickly. But what if the numbers looked like this instead? A $2,000 loan at 4% and a $10,000 credit card balance at 22%. The snowball would still say attack the 2000 first. But that is like trying to put out a campfire while your house is burning down. The smarter strategy, mathematically, is the debt avalanche. You attack the highest interest rate first, because every extra month that high interest debt exists is draining money from you. A study from Harvard Business Review found that people who used mathematically optimal repayment strategies save hundreds to thousands of dollars more compared to balance-based strategies. So yes, the snowball feels good, but good feelings do not reduce interest charges. Numbers do, and this leads us to the next problem. Now here is where things get really interesting. Ramsey often recommends pausing all investing until you are completely debt-free. That includes retirement accounts. Even if your employer offers a 401k match, let that sink in. You are walking away from free money. Let's do some simple math. Imagine your employer offers a 100% match on the first 4% of your salary. You make $60,000 per year. If you invest $2,400, your employer adds another $2,400. That is an instant 100% return. Now imagine Ramsey tells you to pause investing for 3 years while you eliminate your debt. You just missed $7,200 of your contributions, plus another $7,200 of employer matching. That is $14,400 not invested. But here is where compounding enters the story. If that money grew at about 8% annually for 35 years, that missing investment could have become more than $200,000 from just 3 years of skipping contributions. That is the power of time. And when people pause investing entirely, they're essentially pressing pause on compound growth, which leads to the next controversial point. If you have listened to Ramsey long enough, you have probably heard this claim. He often says investors can earn about 12% annual returns in mutual funds. Sounds amazing, right? The problem is that is not what most investors actually experience. Historically, the S&P 500 has averaged about 10% before inflation. After inflation, the real return is closer to 7%. And that is before accounting for fees, taxes, bad timing, and emotional investing mistakes. According to research from a firm called Dalbar, the average investor significantly underperforms the market due to buying high and selling low. Their studies have shown that the typical investor earns closer to 5% annually. Now, think about the difference. If you assume 12% returns, your retirement projections look incredible. But if reality ends up being 6 or 7%, you may need twice as much money to retire comfortably. It is the financial equivalent of planning a road trip, thinking your car gets 80 miles per gallon. You're going to run out of gas much earlier than expected. And this brings us to something even more controversial. Credit cards. Now, before the comments explode, let's clarify something. Credit card debt is dangerous. High interest, easy to abuse. For many people, Ramsey's strict rule of no credit cards ever protects them from financial disaster. But mathematically, credit cards themselves are not the problem. It is how people use them. Consider this example. You pay off your credit card in full every single month. You earn 2% cash back on everything. Your monthly spending is about $2,500. That is roughly $50 per month in rewards, or about $600 per year. Invested over 30 years at 8% returns, that cash back alone could grow into roughly $70,000. And that is not even counting travel points or sign-up bonuses. Of course, if someone carries balances, that 20% interest wipes out everything, which is why Ramsey bans them entirely. But banning tools, because some people misuse them, is a little like banning kitchens, because some people overeat. The tool is not the problem. Behavior is, which leads to a bigger philosophical issue. Here is the thing most critics actually agree on. Dave Ramsey is not really teaching finance. He is teaching financial behavior change. Think of it like dieting. If someone is severely overweight, the best diet is not the most scientifically perfect one. It is the one they can stick to. Ramsey's system works because it is simple. Clear baby steps, clear rules, no gray areas. And that simplicity has helped millions escape debt. But once you are financially stable, the system can become limiting. It is like learning to ride a bike with training wheels. At first, they are incredibly helpful, but eventually they slow you down. Financially sophisticated strategies like tax optimization, diversified investing, and long-term compounding strategies are mostly absent from Ramsey's advice, because his system is built for beginners in financial crisis, not for long-term wealth optimization. And that distinction is crucial, because if you never move beyond beginner rules, you may never reach advanced results. Now here is the concept that ties everything together. Opportunity cost. This is the value of what you give up when choosing one option over another. Ramsey focuses heavily on eliminating risk. Avoid debt. Avoid credit cards. Avoid complexity. But in finance, avoiding risk can also mean avoiding opportunity. Imagine you aggressively pay off a $20,000 student loan at 4% interest. You throw every extra dollar at it. You eliminate it in 2 years. That feels amazing. But what if instead you invested that money in a diversified portfolio earning around 8% annually? Over those same 2 years, the difference might not look huge, but over 30 years, that gap can become hundreds of thousands of dollars. The longer the time horizon, the bigger the opportunity cost becomes. And this is the mathematical blind spot critics point out. Ramsey's approach often sacrifices long-term growth for short-term simplicity. So what do you actually do with this information? Because knowing the math is one thing. Applying it to your life is another. First, capture your employer retirement match immediately. If your company offers a 401k match, prioritize this first even if you still have debt, because a 100% match is essentially doubling your money instantly. Today, check your employer retirement benefits and contribute at least enough to receive the full match. This usually takes about 10 minutes online. This single step alone could add tens or even hundreds of thousands of dollars to your retirement over time. Second, consider using a hybrid debt strategy. Instead of blindly following Snowball or Avalanche, combine them. List all your debts and identify the highest interest rates first. But if a small balance is emotionally draining you, knock it out quickly for motivation. Think of it as 80% math and 20% psychology. Third, start investing earlier than you think. Time matters more than perfection. Even small investments in your 20s and early 30s can outperform larger investments started later. For example, investing about $300 per month starting at age 25 could grow to around $700,000 by retirement, assuming roughly 8% returns. Wait until age 35 to start, and you may end up with less than half of that. Same monthly contribution. Huge difference. Finally, learn the next level of personal finance. Ramsey's system is a great starting point, but eventually you will want to understand index fund investing, tax-advantaged accounts, asset allocation, and long-term compounding strategies. Think of Ramsey as financial literacy 101, but wealth building often requires financial education at higher levels. Commit to learning one new financial concept every week. Your future self will thank you. So here's the big takeaway. Dave Ramsey is not necessarily wrong. His system has helped millions of people escape debt and regain control of their finances. But getting out of debt and building maximum wealth are two completely different strategies. Ramsey's advice prioritizes behavior and simplicity. But if you ignore the math of compound growth, opportunity cost, and investment timing, you could accidentally slow down your financial future. The real breakthrough is using the psychology that works while still respecting the math that builds wealth. If you found this helpful, subscribe for more videos where we reveal the financial strategies schools never taught you. And in the next video, we are diving into the index fund strategy that quietly created thousands of millionaires. Because sometimes the smartest financial move is also the simplest.